Hi, welcome to this live webinar where we're today discussing split year treatment for expats specifically. The expat can be coming to the UK or leaving the UK, and that makes quite a difference. But it is quite an interesting situation, and it's very complex because, as we keep saying, there is residents, non-residents, residents, tax residents, and domicile at play here. And each of those three factors have making a different decision in terms of whether you're a tax resident or non-resident. What a split year does, it allows you during any UK tax year to be non-resident for just part of the year and resident for the remainder. That can be an expat returning to the UK, or a new expat coming to the UK, or it could be an expat leaving the UK, or UK citizen leaving the UK as an expat, going expat for the first time. So split year allows you to break up the year and protect your overseas income during that period of time. But there are a number of different rules that you need to consider and criteria that you need to match. First of all, there's 8 criteria when you can actually be considered to be consider using a split year. So let's consider those. And we're looking at what the expat could be: somebody that's leaving the UK or returning to the UK. And as we said last week, with residence issues, that there's 4 key criteria in determining any non-resident status, and that is where the family is, where the accommodation is, where the work is, and what the 90-day rule, how that applies and affects you during the current year. So, and we've got a guide that you can download from our website at proactpartnership.com for that decision-making tree. The family is the most important criteria, then the accommodation, then work, then the 90-day rule. But each of those has a vital impact on whether you can be a tax resident or non-resident. And we're looking in terms of taking advantage of split year in this vlog, in this webinar. So we're not looking at criteria, some of the more extended criteria, which we'll cover in future episodes. So when we want to utilise a split year, the first thing we need to consider, we could be starting full-time work overseas. Starting a part-time work or going to work overseas as a remote worker doesn't necessarily cut it on its own to be going non-resident. So somebody who wants to go and be a remote worker but is carrying on with the UK contract is not necessarily going to automatically be able to get split year treatment. We need to do a bit more work on that contractually with the employer, as well as meeting some of the other criteria. So are you starting full-time work overseas, or obviously that would apply to a spouse or a partner of somebody who's starting work overseas. So we talked about as well, one of the important factors being a home. So if you cease to have a home in the UK, that could be a criteria for an expat. So if you've been working in the UK or living in the UK and then you sell that house or you rent it out and you no longer got that home, that could be a reason to become non-resident and take a split year basis. Conversely is true. If you take a home, buy a home, or have an accommodation, a rental accommodation in the UK, that will be another case in which we can use split year treatment. If you're starting to have a home in the UK for the first time, the basis for split year, how do we define a home? The home has got to be available to you for 91 days during the year, and you've got to use it for at least 30 days. So UK expat could go overseas and keep accommodation available for them. And they might want to do that to protect themselves against capital gains tax on a future sale of that residential property. Residential property in the UK, which is your main home, is capital gains tax free, saving up to 28%. But if you keep that property available to you and nominate it as your main residence, even though you're overseas, it's giving yourself a tie and making your non-residence slightly more difficult. So it's something to consider and to factor into the equation. If you're spending 30 days in the UK in that property, then that home issue, that accommodation issue, is becoming a factor in terms of determining whether split year could apply or not. If you're coming to the UK and you're going to be there for at least 3 months, then split year rules would apply. It doesn't mean that you can't apply split year for just 1 month or 2 months. It is entirely possible. Starting work in the UK is another criterion which split year rules apply. But if you're a UK expat and you return into the UK, if you cease your overseas work, but you're coming back to the UK but not necessarily coming to work, then again you can have split year treatment to protect that years. So if you're working in the Middle East and you've got a gratuity payment at the end of contract, that end of contract payment and that earnings for the year to date can be protected using split year, and even though you haven't got work to come back to in the UK. And also, of course, that applies to spouses coming to the UK. One thing that you do need to consider with split year is capital gains. And capital gains has got a little twist, because if the capital gain occurs, that's a chargeable event, but it could still apply. So an expat leaving or returning to the UK could still apply, have a capital gains applied to them, even though they're non-resident with a split year. So let's look at that scenario. If you leave the UK on the 1st of July and apply for split year for your overseas work, that's fine. If you then have a disposal which is subject to capital gains, be that crypto investments, that is a current year capital gains liability, and that capital gains liability will be applied even though you're non-resident. So even if the disposal is in your non-resident part of your split year, you'll still be charged that capital gain during that year, because there isn't a tax year end passed by. So as far as expats are concerned, using split year doesn't protect them necessarily from capital gains during the year, whether that's abroad or the UK. So an expat returning to the UK could be liable for overseas capital gains if the disposal is during their UK period of their split year. In theory, on your UK period of your split year, you've still got up to 90 days that you could spend in the UK. That's not an absolute rule. You need to look at what the rules and the conditions are. So you can't, for example, leave the UK on the 1st of February and then come back and spend most of the remaining part of the tax year as resident. You have to play by the rules. But if you're leaving on the 1st of July, potentially that you could still spend up to 90 days during the split year part of that year, if that was needed. So that's what split year is for. So again, using the 1st of July as a date, if we're talking this month, 4th of July is the halfway point in the year, and so in a calendar tax year, a country, you've been in the country for 183 days. Anyone who's been in country for 183 days is tax resident. So if an expat is in a country in the UK for 183 days, that's between April and October the 5th. For 183 days in a calendar tax year, country, that's 4th, 5th of July, that you need to be in country to be automatically tax resident. But somebody who's started work abroad, calendar tax year jurisdiction on the 1st of January, so from the 5th of July, they're automatically going to be tax resident in that country. They could be already for the work that they've been doing during that year. And split year treatment can apply. It can either apply from the 1st of January or it can apply for the 1st of July or whatever is appropriate. So if they're returning to the UK on the 6th of July, the tax income 1st of January to the 6th of July is all taxed in the overseas jurisdiction, and only income earned and capital gains earned after the 6th of July would then become taxable in the UK. Split year has got great advantages. You've still got your personal allowance. It still gives you protection. It doesn't give you protection for capital gains during the current year. You've got to go over the end of a UK tax year to protect you going forward. But it allows you to protect overseas earnings and gratuity payments and disposals before you come back to the UK. For more information and guidance on how that split year can be used to manage your circumstances when relocating abroad, contact us at proactpartnership.com. Final point I want to cover today is that there is a statutory non-residence test and a statutory residence test that we can use, which can undermine or support a split year treatment. But in bearing that in mind, one of the rules is the 90-day rule. If you've been in country for 90 days in any of the last 3 years, that's automatically going to come in and factor into any split year decision. So the statutory test rule is not necessarily going to be applied. So potentially you can get a statutory test and during the current year, but not in the year of your split treatment. The split treatment rule applies for this year. The statutory test applies for the next year. But you're always going to be undermined by the 90-day rule until you've spent at least 3 years outside the UK with less than 90 days in country in any of those 3 years. So that's an added case and scenario. So if you're looking to relocate overseas and protect yourself from UK earnings and capital gains, then you need to spend. You need to go over the end of the tax year and then have 3 full tax years outside to fully protect your income, and over 5 years to protect against any capital gains that are realised while overseas. All these things we cover at proactpartnership.com. You can subscribe to this YouTube channel and watch further information and guidance here. We've got a retained client service where we offer online advice and guidance at proactpartnership.co.uk. So go along there and you can register for that advice and consultant reviews online. And if we can help you with your expat adventures, relocating overseas, we offer tax saving reports and your tax service for expats living and working abroad.